Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so next up we have net operating losses. So what are net operating losses? Well, this is a loss, so generally bad news bears. Okay, so in the world of tax, this is defined as a result when a company's total deductions are in excess of their total operating income in a reported tax year. All right, in other words, they spent more money than they made. Okay, but just like other bad things on paper, the IRS will potentially allow you to take this as a deduction or a tax benefit. Same story goes for net operating losses. Okay, so for today's CPA exam, we have a few scenarios that we need to be familiar with. And ultimately, it comes down to understanding when the net operating loss occurred. So scenario number 1, the net operating loss occurred in a tax year beginning after December 31st, 2020. So in other words, January 1st, 2021. So this is going to fall within our 80% of taxable income rule. Okay, so if the loss itself occurred in a tax year after December 31st, 2020, then it can only offset future taxable income up to 80%. And for this situation here, there is no carryback. So if we don't utilize it, then we can only carry it forward indefinitely. Okay, I say only. Indefinitely still sounds like a pretty good deal to me. All right, but what if the loss occurred before December 31st, 2020? So if the loss itself occurred between after December 31st, 2017, right? In other words, January 1st, 2018, the IRS likes to always make things so complicated with their wording. Anyway, up to December 31st, 2020, right? So this 3-year time period, the rules are going to be a little bit different. In this event, the net operating loss itself can be carried back 5 years and carried forward indefinitely. And it's not going to be subject to the 80% of future taxable income limitation. This limitation only begins after December 31st, 2020. Okay, so the start of the new year, 2021, the 80% limitation is going to go into effect. And also at the start of the new year, 2021, the carryback rule is no longer going to be in effect. We can only carry these losses forward. Okay, so between these years, we could carry it back 5 years, carry it forward indefinitely. All right, so let's run through a quick example. Okay, so let's say that NOLA Inc. reports a net operating loss of $400,000 in the year 2021. How can we treat this net operating loss? And again, it's going to come down to the dates. All right, so because this happened in 2021, this can only be carried forward indefinitely up to 80% of the company's taxable income. Okay, so we talked about capital gains and losses for individuals. Now let's talk about capital gains and losses for corporations. Okay, so the rules are going to change when it comes to recognizing capital losses for corporations. And we need to keep this in mind because the exam isn't going to tell us this is the individual tax portion of the reg exam. This is the corporation section of the reg exam. You have to be able to look at a question, immediately identify what it is they're asking, and then be able to compare each respective rules. Okay, so what are capital gains? Capital gains are going to represent a C corporation's sale of appreciated assets that are not used in the ordinary course of business. Okay, so we're not selling assets such as inventory, right? That's how we would generate revenue. Capital assets are going to be other types of investment assets. So if a company sells, let's say, securities that they own, any gains from the appreciated value of the security at the time of sale over the book value, right, the basis, would result in that capital gain. Same goes for capital losses, only now the sales price is going to be less than the book value of that investment asset at the time of sale. So the key to this module is understanding how we're going to treat capital losses. So this is going to be different from individual recognition. Unlike individuals, corporations can only offset capital losses to the extent of their capital gains. Right? If we think back on individuals, they can deduct capital losses in excess of their capital gains to the extent of $3,000 off ordinary income. Right? They could take a $3,000 adjustment. Not going to be the case for corporations. Okay, so what about unused capital losses? Right? What happens to capital losses that exceed capital gains? For corporations, as we mentioned, we can't offset that ordinary income up to $3,000. Okay, we also know that individuals can use that excess capital loss as a carry forward for an unlimited amount of time. Right, so individuals could take their capital losses, use it to first offset capital gains, then use the remaining portion to offset up to $3,000 of ordinary income. And if they still have existing capital losses after that, then they can carry it forward indefinitely. All right, corporations, rules are going to be a little bit different. After the capital loss first exceeds capital gains, we know that we don't have the deduction. Okay, and we also are not going to be able to carry it forward for an unlimited amount of time. So the rules for corporation is going to be 3 years back, 5 years forward. Okay, the 3 and 5 rule. Think of it this way. The IRS is going to be less lenient on corporations than they would for individuals. Right? It sounds like a sweeter deal that you can not only offset ordinary income up to $3,000, but you can also carry this forward for an unlimited amount of time. Okay, so there's a time cap for corporations. 3 years back, 5 years forward, that's it. Okay, so taking a look at a quick example, Universal Inc. reports gross income in the amount of $1 million in the current year. Additionally, the company has sold an investment asset at a loss for $250,000. We just want to know how we are going to treat the $250,000 loss. Okay, so we cannot take a deduction in the current year. And the reason is because there isn't a capital asset to offset this $250,000 capital loss with. Okay, so if we cannot use it to offset capital assets in the current year, because this is a corporation, we could carry it back 3 years and forward 5 years. If this was an individual, we can deduct up to $3,000 off this $1 million in income in the current year. All right, so we got to know the differences in rules for individuals versus corporations.